Hi, it's Mike. Welcome back to the channel. In today's video, we're going to talk about something that affects the housing market, and that's mortgage rates. Something recently happened with the Fed that could mean lower mortgage rates down the road. Stick around to the end of the video to get all the information. Let's get into it. So let's take a look at this chart. This is the overnight repurchase agreement where the Treasury comes in and steps in to provide liquidity to the banking system. As you can see, this goes back to 2021, and the Fed has not had to step in with the banks because they were flush with cash. Now, back in October of 2024, they had to step in slightly, but look at this at the end of the month where they recently had to step in a quite substantial way. What is that going to mean for the market? Well, historically, anytime the Fed has had to step in to this level, it normally means that mortgage rates are going to have to come down. And we're not talking about just 0.5%. We're talking about probably 1 to 2%. And this could happen in the next 12 to 24 months. If you currently look at what mortgage rates are in the UK, you can see right here that they're around 4.89%. The average is 4.26%. But they're down under 5%. If we go into Japan, you can get a fixed rate mortgage at just over 1%. And if we go into Germany, you can see that the rates are 3.5% to 5%. So let's watch this little video. It's going to explain more what happens. And comment down below what you think about mortgage rates and what rate is going to be most effective to get people back into the housing market.
What's happening? The Fed just stepped in to help banks because they're having a hard time getting cash from each other. Just like what happened before big financial problems in 2008 and again in 2019. This repo market is like a place where banks borrow money overnight to keep running. If that breaks, it's bad news for the whole system. Why it matters? In the past, when the Fed did this kind of emergency help, they also made borrowing money cheaper, lower interest rates. When borrowing gets easier, stocks, real estate, and crypto prices go up fast, but only for a while. What usually happens? The Fed prints money. Rich people spend it on assets. Asset prices skyrocket. Later, normal people feel richer and spend more, which pushes up prices everywhere, inflation. Then the Fed raises rates again to slow things down, and prices fall, a bust. Where we are now, 2025, the extra money from 2020 is gone. Banks are running out of cash again. The Fed is stepping in. Inflation is low, so the Fed might cut interest rates soon. That could cause another short-term boom in prices, stocks, homes, etc. What to expect? Fed could cut rates by 1 to 2%. They might print more money again to help the system. This would make things feel good short-term, but it's not real long-term growth. Final takeaway, simple version. The Fed is trying to keep the banking system alive by making money easier to get. This might lead to another short-term boom in prices like we saw in 2020. But don't be fooled. That boom will probably be followed by a bust. Be smart, don't chase risky bets, and make sure your money is invested wisely.
Thanks for watching today. Watch some of our other videos. Have a great day.